Hello and welcome back to all our viewers to this channel. Once again, I'm very pleased that we are in conversation once again with John Wraith. You may remember John Wraith introduce himself. He is the ex-UBS head of UK rates strategy. He knows everything there is to know about the bond market and more. And so, John, today we're going to talk about inverted yield curves. But before we get there, there's a few things we need to understand. So I understand this is obviously about the bond market and bonds. Can you just describe what is a bond?
Yeah, sure, Ted. Let's start off by taking it in its simplest form and say that at least when it first starts life, it's the same thing as an IOU. So if you and I entered into an agreement where I lend you some money for a defined period of time, and I ask you to pay me some interest on a regular basis on that loan, and then at the end of our agreement you give me back my money, we've essentially created the same thing as a bond, as is traded in multiple trillions of dollars on the bond markets all day, every day throughout the year. So typically they're issued by governments throughout the world, large companies in particular. There's all manner of varieties of that sort of simplest form of the instrument, but that's essentially what they are. So in the UK, the government has constant, very large borrowing needs, both to cover its borrowing requirement and also to raise money to spend on big infrastructure projects, for example. It raises that from the markets, institutional investors, pension funds, for example, life insurance companies. It pays them interest on the money that they lend to the government, and then at the end of the period, it pays them back their money. That, in its simplest form, is what a bond is, and that's what we're talking about today.
Excellent. So just to get just so I got this right, so it's, for example, if I want to borrow $100,000 from you, and I'm going to pay you back in 10 years' time, and in the meantime, I'm going to pay you a 5% rate of interest. That's all well and good, but the problem for John, for example, is that if he then kind of needs the money tomorrow and he phones me up and says, "Ted, give me my money back," I'm going to say, "No, I've got a contract here that says I don't have to give it back to you for 10 years. And that causes a liquidity problem or kind of cash flow problems for John. And so what he does is that I then create this bond. And as John says, it is tradable in the market. And if he needs the money tomorrow, he can just sell it on to somebody else. A little bit of terminology. You can correct me if I'm wrong here, but the $100,000 is the nominal or face value. That's what you're going to get back at the maturity date. And in the meantime, we're going to get a coupon rate. So rather than paying interest, we pay coupon, but that's basically the same thing. And John, I mean, a lot of people say to me, "Ted, I've got enough debt of my own. Why would I want to buy somebody else's debt?"
Well, I suppose the answer to that is there's a price for everything, essentially. And this is where it comes back to the point you just made, Ted, about this debt being tradable. So on day one, if we take the example again of the UK government, it issues the bond, it borrows the money, it says we're going to pay 2% on this. Over time, all the circumstances that affected the decision of the lender change, whether it's the creditworthiness of the UK government, the markets and the economy more generally, views on inflation, the rest of the financial world, appetite for risk, all of these things change. And therefore, the 2% that the initial lender might have been happy to receive as their annual rate of interest changes. And if effectively another lender or someone who might be buying that bond in the market views the UK government as less attractive for any one of those reasons, that lender will say, "I don't need this, I don't want it, I don't want it for 2%. I will, however, lend you the money if you'll give me 3% or 3.5% or 4%. So as I say, there's a price for everything. The return on those bonds therefore has to move around so that the debt that is issued, in this instance by the UK government, is tradable within the markets, and investors will always have a demand for that bond if the return is high enough or matches their appetite.
Okay, so that's an interesting point you're making there, John, because a lot of people will say to me, well, Ted, if I say to them, how much are you going to pay for this? They go, well, it's $100,000. That's what's looking at me. But of course, that's the nominal or face value. That's what you get back at the end. That's not what the market is, the market value. So what John is saying is that this bond, because it's traded in the market, because it's traded, it's constantly changing in price. Now, just to get this right, John. So in terms of the coupon in our example is fixed. I know you can get kind of variable or linked to RPI or CPI or whatever else it is, but this is generally fixed. And so obviously when we say I work in the fixed income markets, I guess you work in the bond markets, of course. Yeah. And of course that maturity date is also fixed. So just run me through, you talk about this kind of, I say I will lend money to the UK government. Let's say I demand 6%, but I've got a bond here that only says 5%. I say that's not compensation to me, enough compensation for lending to the government, and therefore I want a higher rate of return. How does that work?
Well, as you point out, on these instruments, the actual interest, the annual amount of money is fixed. In this example, the UK government or the issuer of this bond will be paying $5,000 every year to whoever owns the bond at each annual interest date, and they will be repaying precisely $100,000 at the defined maturity date to whoever owns the bond at that point in time. So the only thing that can move, as you pointed out there, Ted, is the price of the bond today. Put it this way: if I'm thinking about buying this bond, let's say you've bought it on day one, you've lent the money to the UK government, you're happily receiving your 5% on your $100,000 investment. But I think, well, I'll buy that bond from Ted, but I think the UK government is riskier than he thought on day one. Or I think inflation is more of a problem. Or I think there's other investments around that are more appealing than this. So I don't want 5%, I want 6%. Well, how am I going to get that? I mean, I know I'm getting 5% in this, as you said, fixed income, fixed interest every year. So effectively to generate another 1% in the annual yield, so to get from 5 to 6, I need to pay a price today which is lower than $100,000. Let's say it's $95,000. This is all worked out on bond calculators and Bloomberg's and so on. But let's say it's $95,000. I spend $95,000 today. I then get $5,000 every year. And in 10 years' time, I get back $100,000. So I've made 5% every year, but I've also made the difference between the $95,000 I've paid today and the $100,000 I get back at the end. So that's why the price has to move around, so that the coupon effectively is turned into a yield. You get a return, a total return on your investment, which is the coupon plus the difference between the price you pay today and the money that you get back when the bond matures.
And it's obviously a very complicated calculation, John, and that's why we're using Bloomberg. And for the sake of this example, we don't really need to know the intricacies. But what we do need to know that if I pay $100,000 for this bond, I'm getting a yield of 5%. And just to reiterate, if I pay more than $100,000, then I'm getting a yield of less than 5%. And if I pay less than $100,000, I'm getting a yield of more than 5%. So while the coupon stays constant, the yield changes in relation to the price that anyone pays, and that price is obviously set by the market. So if the price is changing, and you kind of alluded to it there, but I just want to be very specific. What are the two main reasons that the price of a bond is going to change?
One is the general interest rate environment. We're talking about a 10-year investment here. Let's say, as we indeed have, on day one, 5% is the fair value for 10-year bond issued by the UK government. If the interest rate environment, the global interest rate markets, the UK interest rate market sees a general rise in rates, as indeed we're starting to see in major economies across the world over recent months, then the sort of interest rate backdrop will typically cause yields or returns on bonds all the way down the yield curve to rise. Investors are asking for a higher return on their money because official interest rates are rising everywhere.
That's going to kind of make sense. I mean, just looking at it very simply, if I pay $100,000 for this bond and I earn 5% and I can get 10% in my bank, I'm not going to buy the bond. I'm going to put the money in the bank. And if I put the money in the bank, nobody buys the bond. Demand goes down. As demand goes down, the price goes down. And as we can see, the price goes down, the yield goes up. So that kind of makes sense, John. What's the other reason?
Well, the other reason, and I think we're starting to sort of zero in on the topic of today's talk, is to do with risk, perceived risk. And what that essentially means, again, to put it in sort of simple terms, if I'm lending money to the UK government, I'm going to be pretty convinced I'll get that money back if I'm lending it to them for a week or a month or a year. But if I'm lending it to them for 10 years, 30 years, 50 years, then all else equal, I'm less certain I'm going to get that money back. Something could happen over that longer term frame, which makes the UK government less creditworthy. There are risks to my investment. Something could happen to sterling. There could be a risk of a default. Now, on a sovereign bond, on a bond issued by a high quality country, it's highly unlikely that you're looking at default over a medium to long term period. But clearly, it is a riskier thing to do. Put it another way, if I may, if I'm lending the money to you, Ted, I'd be much more likely and confident I'm going to get my money back next week than I might be in 10 to 30 years' time. So if I was lending you the money for a long period, it is a riskier investment for me to make. And therefore, all else equal, I would usually demand a higher return on the money for lending for a longer period of time. It's called the term premium. And that's why in that environment, a normal yield curve or the normal sort of profile of rates as you go further down the maturity spectrum is rising.
Okay, so that's an interesting point, because often when we think about risk between two enterprises. So obviously, John, if somebody was to lend money to me, I'm good for it. I'm a solid, safe bet, and therefore I'm a low risk. Whereas if they were to lend money to you, maybe I know, you've been working the financial markets, John. You'd probably kind of squirrel it away, change your name, and disappear off into a kind of off on your super yacht. So maybe you're high. So that's kind of comparative risk, but you're bringing in this other concept of and I get that now, that the longer you lend money to me, the less likely you are to get it back, because more things could go wrong. So let's say I could get hit by a bus. I'm more likely to get hit by a bus in the next 30 years than I am in the next 30 minutes, for example, especially as we're on the call today for the next 30 minutes. So that's highly unlikely. So there's a time maturity, and you talk about sort of further down the curve and that kind of terminology. And this is our yield curve. And if we can just have a look, I mean, it's 2013, so it's kind of like, it's very out of date. But I found this chart that just shows the US, the UK, and Germany. And their yield curves are, I guess they're normal.
Yeah.
So inverted yield curve, what does that look like?
Well, as you say, you've got on the screen there a normal or positively sloping yield curve. And it is because of the reasons that we've just been talking about. The longer you lend for, all else equal, the higher return you want. What's an inverted yield curve? It's what it says on the tin, and it's what you can see there now. It's a yield curve that, instead of being positively sloping, in other words, rates rising as time extends, it goes the other way. So the rates on shorter maturities, shorter lending periods, go above those on longer lending periods, which certainly, I hope we've explained why, is highly counterintuitive, but does happen on occasion. And as I said before, that's clearly the dynamic that we're here to talk about today, because it's beginning to happen now in some very important markets, Ted.
So I was looking for kind of examples of inverted yield curves, and here's one for the Greek government bonds in 2011. Now, for those of our viewers who don't have long enough memories, or maybe are too short in the tooth, not long enough in the tooth, 2011 debt financial crisis, Greek kind of struggling to make the repayments, and so suddenly you're thinking, if they owe you money and they're going to pay it to you next week, you're like, oh, I'm not going to sure I'm going to get my money because they might not get a bailout. But if they owe you money and they're going to pay you in 25 years time, you're like, 25 years, that's a long time. They'll have sorted it all out. We'll be absolutely fine. So that kind of makes sense with Greek government bonds. And what I found was this, which was the US, the US kind of yield. Now, I'm going to get Johnny to explain this in a minute, but I'm just going to show for our viewers, and I'm going to use our annotation method. So in effect, zero. So what we're looking at here is the difference between a 2-year bond and a 10-year bond. So something that matures in 2 years, something that matures in 10 years. Obviously, a 10-year longer duration than a 2-year. So you'd expect a higher yield on a 10-year over in a 2-year. And so anything above this kind of zero, that's a positive yield. That's the difference between so for example, up here, the 3-year, the 10-year is 3% more than the 2-year. So anything below is an inversion. So let's look at the inversion. So there's an inversion, 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 and is there about to be an inversion there? And then we also notice that these gray lines are recessions. So we've got kind of 1990, remember the dot-com boom, 2000, we've got the global financial crisis. Did it predict the pandemic? Is that what's going on there? I'm not sure I kind of get this, but why does an inverted yield curve, why do people use it as a predictor of a forthcoming recession, John?
Right. So I mean, this is a remarkable chart. As you said, it relates to the US, and it shows that over the last 40 years or so, an inverted yield curve has indeed been followed shortly afterwards reliably by recession. So what's going on? Well, it's a different dynamic from the chart you showed of Greek yields. And I think the way to differentiate is to say, well, what was going on in Greece back in the years after the financial crisis was real concern that there might be a default, that the euro might indeed collapse altogether, that there'd be a sovereign debt crisis in the coming few years. And therefore, lending money to the Greek government for the next 2 or 3 years was seen as an incredibly risky thing to do. There was also, as Ted mentioned, the view that whatever's going to happen 20, 30 years down the line, we assume things will have been resolved and one way or another we'll be back on the track. So there was that sort of counterintuitive willingness to lend for a longer period at a lower return than for the very risky short term. That's not really what's going on here in the US or has gone on those previous episodes. What's happened there is, I'll put it this way, you have a Federal Reserve typically in those periods that on the way towards curve inversion is raising rates quite rapidly. In other words, there's been a period of decent, strong economic growth, and the economy in the US has been starting to heat up to the point where the Federal Reserve says we need to start raising interest rates. This is exactly what's been happening over recent months. The economy is running hot. They did a lot of stimulus through the pandemic. Hopefully the pandemic is now over, certainly as a major economic headwind. The economy is off to the races, and monetary and fiscal policy are very loose, very stimulative. So the Federal Reserve is rapidly starting to raise interest rates in America. So as it does that, when you think about a 2-year government bond yield, it's basically the market's expectation of where rates are going to be on average over that next 2-year period. That's what you're roughly pricing in when you look at 2-year yields. So as the Fed has suddenly been expected to go from keeping rates at very low levels for a long period of time to being expected to raise rates 6 times this year, potentially by 50 basis points a time, really shove those short-term rates up. So the yields on those 2-year bonds have shot up. Now, as they do so, other dynamics are at play at that longer end in the 10-year sector of the curve, certainly influenced by what the Fed is doing, by expectations about inflation, the reality of inflation that we have everywhere now. But because they're so much further down the line, they're less sensitive to what goes on now. So you get this sort of violent tendency for short-dated rates to rise fast into a period of higher monetary policy rates, while longer rates tend to be less volatile. Now, it is in fact very normal for a yield curve during this period of tighter monetary policy to flatten. So for short yields to rise relative to long yields for the reasons I've hopefully just explained. But in a sort of healthy recovery where everything is happening steadily and stably and the central bank is seen to be in control of things, the general view would be, well, they'll raise rates a bit, but then things will stabilize, and you'll typically have your term premium where longer rates, fair value of longer rates is higher than short rates, will stay in place. However, when a central bank is seen to have been a bit asleep at the wheel and having to race to get rates higher, potentially have to raise them further than they might like to, those short yields can rise not just to a relatively modest degree, but sharply, to the point where the markets say, well, if you raise rates all that way, that quickly, you're going to tip the economy over. And in the 3, 4, 5, 10-year point in time, you're going to have to bring rates down again because you're going to be dealing with a recession. And that's why the yield curve inverts in this sort of warning way ahead of recessions in the US. And that's where we are right now at this juncture. Is the Fed potentially going to be tightening too dramatically, and by consequence dealing with a slowing economy in a few years' time? That's the big question here.
So let's show our viewers. So this is from Bloomberg. This is the latest, and this is a couple of days old, I think, 1 or 2 days old. And then we're zooming in here, so you can see it's the year 2000 on the left, all the way up to today. And I've circled today, or a couple of days ago, and we can see that there's the zero. It's dropped below the zero. The dotted line is now, it's in this kind of this inverted territory. And the last time we were here was 1919, which I'm very impressed that the bond market can predict the pandemic, but who knows whether that's the case. Certainly 2006-7, that's obviously the global financial crisis. And in 2000, it was the dot-com boom and bust there. So, Johnny, are we going into recession? That's got to be the question on everyone's lips. Is the central bank, we're obviously looking at the Federal Reserve here, but kind of if the US sneezes, the world catches a cold. So, are we going into recession, or are we actually going to see the economy? It's inflationary, it's growing, it's going to calm down a little bit. It's transitory inflation, which is what a lot of the central banks, in fact, just the central bank. I was reading an article today in the Times that one of the central bankers, I forget his name, one of the guys on the MPC, just says, look, you know what? It's not here. It's not 1970 stars inflation. There's nothing to worry about. Where do you put your money?
Look, I think at this juncture, certainly if you look at the indicator that you've just put on the screen there, Ted, what you're essentially seeing, certainly if you interpret curve inversion as a hard and fast indicator of expected recession, what you're starting to see now is the market betting that the Fed is getting this wrong and saying, well, if you tighten as much as you say you're going to, then we think you're going to find yourselves having to go in the other direction within the next few years. And that's where this inversion comes from. Now, obviously, the Fed wouldn't be doing that deliberately. So what they're saying or implying is it's necessary to raise rates at this speed. It's necessary to cool down inflationary pressures, which are all too evident, of course, now. And it's another whole conversation about where that is coming from, and is it going to be here to stay? And is it the sort of inflation that needs to be responded to with aggressively higher interest rates from the central bank or not, and so on? But the bottom line is the Fed would say, we are going to raise rates as much as we need to. We're going to do it in a way that means it's the sort of Goldilocks scenario. We will get rates to the right level at the right time to keep the economy running along nice and smooth, full employment, benign inflation, and steady growth. That's what they're essentially always trying to do. So I say it's kind of the Fed versus the market. Who's right? Well, time will tell. My own view is that the inflation scare is a bit overdone now, and that it's going to be painful because consumers are being squeezed. But ultimately, because of that pain and the squeeze that consumers are feeling from viciously higher energy prices, primarily, that's going to cool demand over the sort of 12 to 18 month time frame, which means inflation overall will start to moderate. If that happens, and if it happens before the central bank has sort of overshot with tightening, then we shouldn't see a recession. And it may be, if the market sort of starts to take that view, that we're seeing the curve about as flat as it's going to go, and it'll start to stabilize around these levels. I would say if it goes much more inverted than where we are now, back to the sort of levels we saw in 2000, it's the market screaming at the Fed in this instance that you're going too far and you're going to regret it within a fairly short space of time.
That's quite interesting. So maybe a kind of an alternative to the taper tantrum. So obviously, if they don't get it right, then inflation takes off. We have to put the central banks put interest rates up. Meanwhile, so my mortgage payments go up significantly. Meanwhile, I'm paying more for my energy and for my fuel. And the cost of living is going up. And then if we do go into recession, then that means that there's going to be a higher unemployment. Therefore, I'm desperately trying to cling on to my existing job. I don't feel confident to negotiate for price rises. I don't know. I mean, I'm thinking about, the UK here. We're obsessed with house values. I kind of see a few headwinds for house values in the property market in the UK over the forthcoming years, or am I misreading that?
Well, I mean, I think there's headwinds for consumption generally. I think you're absolutely right about all of that. People, if they're lucky, might get a 3%, 4% pay rise, but inflation's running at 6, probably on its way to 8, and who knows where. So people are getting squeezed on their disposable incomes. And for inflation to stay at high levels, it's a year-on-year reading. It means prices don't just go up by 6, 7, 8% this year, but they have to go up by that next year and the year after and the year after. Now, that's the sort of inflation central banks really worry about. And that can really only happen if consumers can somehow continue to pay prices going up at that rate. And I think, particularly with what's going on with energy prices, that's just highly unlikely. So that's why my view is that inflation will, to an extent, take care of itself. If it does so in time for the central bank to sort of then ease off a bit on the currently anticipated tightening, then there'll be a bit of a sigh of relief, and maybe assets like housing, equity markets, all manner of assets will sort of stay relatively well supported. But clearly, if the central bank has to raise rates further and further and further, even as people are getting squeezed on their costs of living, then it could certainly end badly for property or a whole range of other assets. And the jury is out at the moment. I think we just have to sort of watch and hope that the ship rights itself to a degree, and that some of these violent rises in external prices like energy come under control.
Excellent. Well, that's been a real education, Johnny. So thank you very much indeed for your time. And there we go. Inverted yield curves. Are they the crystal ball? Are they the way that we can see a little bit further into the future? Or is it just a bunch of hocus pocus, and maybe this time it's different? We have no idea. So thank you very much to John for your time, and to everybody else, please don't forget to like, share and subscribe to this channel. If you like what we're saying, if you've got some comments, then please leave those comments. If you agree with John or myself, then leave the comments. If you disagree, you're also welcome to obviously leave comments. Do remember to please be polite. Like, share, subscribe, and we look forward to seeing you back here on the next time that I'm talking to John. And also, if there's anything you want to ask him, any questions you've got, anything that doesn't quite make sense, you've always wanted to know what something was, I don't know, negative yields on German bunds or anything like that, then do just drop it in the chat and we will pick it up at one of our videos. So until the next time, John, thank you very much for your time.
Thank you for yours. Cheers.